Most passive income strategies are actually just second jobs that pay less than your first one. You have seen the viral clips. The promise that if you just start dropshipping or fill out online surveys, you will be sipping coconuts on a beach next week. But when you actually try them, you find the uncomfortable truth. You are not building freedom, you are just building yourself another boss. If you stop working and the money stops flowing, that is not passive income. That is just a hustle with better marketing. And chasing those hustles is exactly what keeps intelligent, hardworking people trapped on the hamster wheel, exhausted, confused, and wondering why they are not getting ahead despite working 80 hours a week. Real wealth, the kind that allows you to wake up without an alarm clock, does not come from doing more tasks. It comes from owning assets. It is the difference between being the landlord and being the property manager. One is a job, the other is equity. In this video, we are filtering out the noise. No schemes, no hacks, just 7 specific vehicles for 2026 that actually bridge the gap between labor and capital. Because the goal is not just to make more money, the goal is to stop trading your life for it. Most people think the solution to financial stress is simply more hours, more clients, more side hustles. But more is often a trap. If your income formula relies strictly on your personal output, time multiplied by effort equals money, you have built a ceiling over your own head. You are the bottleneck in your own financial life. This matters specifically right now because the economic landscape of 2026 is unforgiving to labor. We are seeing a divergence where labor is being devalued by automation and efficiency while assets are appreciating. If you are only selling your time, even at a high hourly rate, you are fighting gravity. The gap between those who own equity and those who rent out their time is widening, and you need to be on the right side of that equation. The old advice to work hard and save 10% is mathematically broken. Inflation erodes savings faster than most people can stack them. You cannot save your way to freedom anymore. You have to build your way there. But here is the distinction most people miss. Passive does not mean lazy, it does not mean zero effort. Building a machine takes work, but once that machine is running, it produces output without you constantly pushing it. We are looking for leverage. We are looking for specific vehicles where 1 hour of work done today continues to pay you dividends for years. If you miss this distinction, you remain in the time for money trap. It does not matter if you make $50,000 or $500,000 a year. If you stop, the money stops. That is a fragile existence. True passive income buys you something more valuable than luxury goods. It buys you the ability to say no. It buys you autonomy. The first vehicle is the one most people dismiss because it feels too slow, too boring, or too simple. But in the psychology of wealth, boring is usually a synonym for effective. We are talking about broad market index funds and dividend growth investing. Now, before you skip ahead looking for a secret, you need to understand why this is the cornerstone of every serious fortune. It is not about playing the stock market. That is a gambler's mindset. This is about owning the means of production. Here is the reality of the economic machine we live in. There is a widening divide between capital and labor. Labor, your time and effort, is currently under siege. Automation, AI, and efficiency algorithms are all designed to do one thing: reduce the cost of labor to increase the profit of the company. If you are purely a laborer, you are competing against this wave. But if you are an owner, this wave is pushing you forward. When you buy an S&P 500 index fund, you are not just saving money. You are buying a stake in the companies that are leveraging the technology that threatens your job. You are hedging your own obsolescence. You are moving from the side of the equation that costs money to the side of the equation that keeps it. The psychological barrier here is patience. The human brain is wired for immediate feedback. You work a day, you get paid a day. That is linear. Market investing is exponential. In the beginning, the passive income from $100,000 might only be $3,000 a year. It feels insignificant, so most people stop. They cash out to buy liabilities that depreciate, but the wealthy understand the snowball effect. They know that the first million is the hardest because you are pushing the snowball uphill. After that, gravity takes over. In 2026, the most passive thing you can do is simply own the global economy and do nothing. You are betting that tomorrow 8 billion people will wake up, brush their teeth, and buy food. As long as they do that, you get paid. This brings us to the second vehicle, and this one requires a shift in how you view your own value. Digital real estate, specifically intellectual property. If the first vehicle was about leveraging money, this one is about leveraging knowledge. Most professionals fall into the service trap. You are good at something, so you sell your time to clients. That is active income. If you get sick, your income drops to zero. You are the bottleneck. Digital products like courses, templates, and paid newsletters break this dependency. They utilize what economists call zero marginal cost of replication. Think about it. If you own a bakery and you want to sell 1,000 loaves of bread, you need 1,000 times more flour and labor. Your costs scale with your revenue. But if you create a digital system, a guide on financial management, for example, it costs you time to create it once. Whether you sell 1 copy or 1 million copies, your cost of goods sold is virtually zero. The profit margin is nearly 100%. The barrier isn't technology, it is the belief that you have nothing to sell. But here is the reframe. You are not selling information. Information is free on Google. You are selling organization and implementation. You are selling a shortcut. People are drowning in free information, but they are starving for wisdom. If you can save someone 50 hours of frustration for $50, that is a trade they will make every single day. Once that asset is built, the sale happens whether you are at your desk or sleeping. That is the definition of an asset, something that works so you do not have to. Now, let's talk about the third vehicle. This addresses the most common misconception in the passive income world, real estate. Let me be very clear. Being a landlord is not passive income. Being a landlord is a job. It is a job that requires customer service, maintenance skills, and conflict resolution. If you are unclogging a toilet at 2 a.m., you have not bought freedom. You have bought a headache with a mortgage attached to it. For 2026, we are looking at real estate syndications and REITs. This is the difference between being a general partner, the one doing the work, and a limited partner, the one providing the capital. In a syndication, a group of investors pools their money to buy a large asset like an apartment complex. The sponsor finds the deal and manages the tenants. You, the limited partner, simply wire your capital and sign the documents. In exchange, you receive a share of the cash flow and appreciation. Why is this superior for high performers? Because of the concept of return on energy. If you buy a single-family home to rent out, your return on investment might be decent, but your return on energy is terrible. You are spending hours managing a single asset. With syndications, your return on energy is infinite. You do the due diligence upfront, and then your work is done. You are leveraging the expertise of professionals rather than trying to be a part-time amateur. So the question is, do you want to own the building or do you want to do the work? Because you can own the equity without owning the job. However, there is a trap here, a trap that catches almost everyone who tries to execute these strategies. The valley of disappointment. This is the period where your assets are growing, but the results are invisible. It is the gap between what you expect to happen and what actually happens. In the beginning, compounding works quietly. You invest time and capital, but the needle barely moves. This is where 90% of people quit. They look at the small returns, calculate their hourly wage, and decide it is not worth it. They go back to selling their time because a paycheck feels safe. But if you can survive the valley, if you can let the asset mature without killing it for a quick payout, you hit the inflection point. This is where the curve goes vertical. The income starts to exceed your living expenses, not because you worked harder, but because the math finally caught up to your patience. This mindset shift is a prerequisite for our fourth vehicle. If you cannot delay gratification, this next strategy will feel like torture. Vehicle number 4 is private lending, or simply becoming the bank. Most of us are conditioned to be borrowers. We look at interest rates as a punishment, but the wealthy look at interest rates as a product. They understand that debt is an asset to the person holding the note. In 2026, the traditional banking system has tightened. Liquidity is harder to access for entrepreneurs. This has created a massive opportunity for private capital. When you engage in private lending, you are flipping the script. You are no longer taking the market risk. You are the senior debt holder. You get paid first. Think about the safety of this position. If a real estate investor buys a house to flip, they take on the construction risk and market risk. If the market dips, their profit vanishes. But you lend them the money secured by the property. If they succeed, you get paid. If they fail, you get the property at a discount. This is collateralized income. It is one of the purest forms of passive cash flow because it requires almost zero maintenance. The barrier here isn't usually money, it is access and trust. You become the liquidity provider for people who are doing the heavy lifting. In a world where cash is becoming more expensive, the person holding the checkbook has all the leverage. Now, let's move to the fifth vehicle. This one challenges the startup culture that has infected social media. Everyone wants to be a founder. They want to start from zero and grind for 10 years. That is a noble path, but it is not a passive one. That is a war. Vehicle number 5 is acquisition entrepreneurship. Buying existing, boring, profitable businesses as an investor, we are living through the silver tsunami. Millions of baby boomers own profitable, unsexy businesses. HVAC companies, logistics firms, laundromats. These are not tech unicorns. They have 20 years of customer lists and consistent cash flow, but the owners are tired. They want to retire, and their children do not want the plumbing business. The mistake most people make is thinking they need to buy the business and run it. That is buying a job. The strategy for 2026 is to act as the capital partner. You partner with a young, hungry operator who has energy but lacks cash. You put up the down payment, they put up the sweat equity, they run the operations, you sit on the board and collect profit distributions. You are buying a stream of cash flow that has already been proven. You are not guessing if the market wants the product. You have 20 years of tax returns proving they do. You are leveraging the previous owner's decades of hard work. They built the engine. You are just buying the fuel to keep it running. Both private lending and business acquisition share a common DNA. You are recognizing that your money is a tool. If you leave it in a savings account, it dies a slow death by inflation. If you deploy it into the economy, it becomes an employee that never sleeps, never calls in sick, and never asks for a raise. But these higher level strategies require capital. What if you don't have it yet? This is where the conversation usually turns to side hustles. But we are going to look at it differently. We are going to look at how you can optimize your primary income to fund these escapes. Vehicle number 6 is the high-ticket intermediary. Most people hear affiliate marketing and imagine spamming links for cheap products. That is the amateur game. The wealthy play a version called strategic partnerships. In 2026, trust is the scarcest currency. Companies have great products but lack trust. If you have a network, you can monetize that trust without building a product. This works by identifying high-value problems. Let's say you know a business owner struggling with payroll. You refer them to a dedicated enterprise solution you have vetted. These commissions are often recurring percentages of the contract value. You are not selling, you are curating. You are extracting value from your relationship capital. The passive element kicks in because once the introduction is made, the vendor does the work, but you continue to get paid. And finally, vehicle number 7. This is the most controversial because it is not a way to make money. It is a way to manipulate the value of the money you already have. Geo arbitrage. Most people view their location as a fixed constant. But if you have successfully deployed any of the first 6 vehicles, your location becomes a variable. And it is the most powerful variable in your financial equation. If you earn $4,000 a month in passive income while living in New York or London, you are struggling. But if you take that same $4,000 to Lisbon or Buenos Aires, you are in the top 1% of earners. You are wealthy. This is the concept of earning in a strong currency and spending in a weaker currency. You are effectively tripling your purchasing power without working a single extra hour. This matters because it lowers your freedom number. If you think you need $10,000 a month to retire, you might grind for another decade. If you realize you can live a better lifestyle right now for $3,000 a month by simply moving your physical body, you have just bought yourself 10 years of life. That is the ultimate return on investment. So we have 7 vehicles: market equity, digital products, syndications, private lending, acquisition, intermediaries, and geo-arbitrage. But here is the truth that ties them all together. None of these work if you approach them with an employee mindset. An employee asks, "How much work do I have to do to get paid?" An investor asks, "How much value can I create so the system pays me?" So how do you prioritize these? You do not pick the one that sounds exciting, you pick the one that matches your resource constraint, time or capital. If we map these, they fall into a hierarchy of leverage. At the bottom, you have the builders, digital products and intermediary work. These are for people who have more time than money. You use sweat equity to build the asset. If you are broke but ambitious, start here. In the middle, you have the optimizers, acquisition and geo-arbitrage. These are force multipliers. Buying a business accelerates your timeline by skipping the startup phase. Geo-arbitrage accelerates your timeline by lowering the finish line. At the top, you have the allocators, market equity, syndications, and private lending. This is the end game. This is for people who have more money than time. Your only job here is to protect capital and let it compound. The mistake I see intelligent people make is playing the wrong game. I see people with $50 trying to invest in stocks to get rich. That is mathematically impossible. You need cash flow first. Conversely, I see millionaires trying to launch dropshipping stores to make an extra $2,000. That is a waste of energy. When you have capital, stop building, start allocating. Ultimately, the goal of all 7 vehicles is identical. It is not to buy a Ferrari. It is not to impress strangers. The goal is autonomy. There is a specific feeling that comes when your passive income exceeds your burn rate. It is a quiet confidence. You walk into a meeting and you realize you do not need to be there. You do not need the client. You do not need the boss. You do not need the raise. When you do not need the money, you become dangerous. You become honest. You become free. Most people will watch this, understand the logic, and then go back to doing exactly what they did yesterday. They will continue to sell their time because it feels safe. But in the economic climate of 2026, safety is an illusion. If your entire livelihood depends on the mood of a single boss, you are not safe. You are fragile. You are one email away from zero. True security only exists when your income is detached from your effort. So look at your resources honestly. If you have time, start building. If you have capital, start allocating. But do not remain a spectator. The gap between the owners and the laborers is widening every single day, and you need to decide which side of the ledger you want to be on. The goal is not to have the most money in the graveyard. The goal is to reach a point where you no longer have to ask permission to live your own life. If this perspective helped you clarify your next move, and you want more signals and less noise, subscribe to the channel. We explore these concepts every week with one goal: clarity. I am rooting for you. Thanks for watching, and I will see you in the next one.